Picture this. You walk into a coffee shop in 2019, order your favorite drink for $3, and walk out satisfied. Fast forward to today, and that same drink costs you $5. Your wallet feels lighter, but here's the real kicker. That extra $2 isn't just inflation eating away at your money. It's a wake-up call that your cash, sitting in a regular savings account, is literally shrinking in buying power every single day. Hey everybody, it's Billy here. If you're looking for a simple, beginner-proof way to protect your money and grow it without needing to be a financial genius, then you are in the right place. Today, I'm revealing how to invest in stocks from scratch without spending hours researching, without needing thousands of dollars to start, and without the stress of picking the wrong stock. Because the truth is, getting started doesn't have to be complicated. So stay with me. Your future self is going to thank you for watching this till the end. What if I told you there's a way to not just protect your money from inflation, but actually grow it faster than prices are rising? And what if I told you that starting with as little as $100, you could potentially build serious wealth over time without needing to become a financial genius or spend hours researching stocks? Today, I'm going to walk you through everything you need to know about investing in stocks as a complete beginner in 2026. By the end of this guide, you'll understand exactly why investing is crucial, how the stock market actually works, what to invest in. Quick disclaimer. Hi, it's your friend, Billy. Please note that this channel is for education and entertainment only. I'm not a financial advisor. This is not financial advice. Talk to a real professional before you do anything with your actual money. I'm serious. Don't be that person. All right, back to the video. This isn't just another generic investing video. I'm going to give you the exact roadmap I would follow if I was starting from scratch today, based on years of experience and what actually works in the real world. Let's start with the uncomfortable truth about your money sitting in the bank. The Federal Reserve targets an inflation rate of 2 to 3% per year to keep the economy healthy. This means that every year things get more expensive and your money loses purchasing power. Here's a concrete example that'll make this crystal clear. Let's say you had $50,000 in 2019. With that money, you could have bought about 16,667 of those $3 coffees I mentioned earlier. But if you kept that same $50,000 in a regular checking account, earning basically zero interest, today you can only buy about 10,000 of those same coffees at $5 each. That's 6,667 fewer coffees for the exact same amount of money. This isn't just about coffee, it's about everything. Your rent, groceries, gas, entertainment, healthcare costs, everything gets more expensive over time, which means your money becomes less valuable if it's just sitting there doing nothing. Now, here's where investing becomes your financial superhero. The stock market, as measured by the S&P 500 index, has historically returned about 8 to 10% per year over long periods. This means that instead of your money losing value to inflation, it's actually growing faster than inflation, protecting and increasing your purchasing power. But there's an even more powerful reason to invest, and it's called compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and once you understand it, you'll see why. Let's say you invest $1,000 and earn a 10% return in year one. You now have $1,100. In year two, you earn 10% again. But now you're earning 10% on $1,100, not just the original $1,000. So you end up with $1,210. This compounding effect accelerates over time. If you left that original $1,000 invested for 20 years at 10% annual returns, you'd end up with over $6,700. But here's where it gets really interesting. If you had $1 million earning that same 10% return, you'd be making $100,000 per year just from your investments. The more money you have working for you, the more money it makes. This is why wealthy people often say, it takes money to make money. They're not just being elitist, they're describing the mathematical reality of compound returns. Now you might be wondering why I'm specifically talking about investing in stocks instead of real estate, gold, cryptocurrency, or other investments. There are three main reasons: accessibility, predictable returns, and liquidity. Accessibility means you can start investing in stocks with very little money. You don't need hundreds of thousands of dollars for a down payment on real estate or thousands of dollars to buy gold bars. You can literally start investing in stocks with $100 or less. Predictable returns doesn't mean guaranteed returns, but it means we have decades of historical data showing that the stock market, over long periods, tends to go up. While individual stocks can be incredibly volatile and unpredictable, the overall market has shown remarkable consistency in its upward trajectory over time. Liquidity is probably the most underappreciated advantage. If you own real estate and suddenly need cash, you might have to wait months to sell your property. Deal with real estate agents, inspections, and paperwork. With stocks, you can sell your investment and have cash in your account within a few days, sometimes instantly. The S&P 500, which tracks the 500 largest publicly traded companies in America, is an excellent representation of the overall stock market's performance. When you look at its chart over the past several decades, you see the overall trend is unmistakably upward, despite various dips, corrections, and even major crashes along the way. This is why successful investing is typically a long-term game. Yes, there will be periods where your investments lose value. The 2008 financial crisis, the 2020 COVID crash, various recessions and market corrections. These are all part of the normal cycle. But historically, if you held on through these downturns and continued investing, you came out ahead. To put this in perspective, if you had invested $100 in the S&P 500 in 1980 and just left it alone, it would be worth over $17,000 today. Even after adjusting for inflation, that $100 from 1980 is equivalent to about $400 in today's money. So your investment still grew over 40 times faster than inflation just by sitting in the stock market. So how do you actually invest in stocks? The first thing you need is an investment account. Think of this like opening a bank account, but specifically for investing. You'll typically choose between two main types: retirement accounts and regular brokerage accounts. Retirement accounts include things like 401k plans through your employer or individual retirement accounts known as IRAs. The main advantage of these accounts is tax benefits, but the trade-off is that your money is generally locked up until you retire. Some people love this forced savings aspect, while others prefer more flexibility with their money. Regular brokerage accounts don't have the same tax advantages, but you can access your money whenever you want without penalties. You'll pay taxes on any gains when you sell, but you have complete control over your investments. In the past, you would have needed to call a stockbroker to place trades, like in those old movies where people are shouting orders over the phone. Today, you can open an account online with companies like Fidelity, Charles Schwab, or Robinhood, and place trades yourself through their websites or mobile apps. Now comes the million-dollar question. What should you actually invest in? You have two main options: individual stocks or index funds and ETFs. Individual stocks mean buying shares of specific companies like Apple, Microsoft, Google, or Tesla. This can work well if you really know what you're doing and have time to research companies thoroughly. However, it's much riskier and more time-consuming than the alternative. The alternative, and what I recommend for most beginners, is investing in index funds and ETFs. These are like buying a basket of many different stocks all at once, which gives you instant diversification and reduces your risk significantly. Let me explain how this works. An index fund is designed to track a specific index, like the S&P 500. When you buy shares of an S&P 500 index fund, your money is automatically spread across all 1,500 companies in that index. So with one purchase, you own tiny pieces of Apple, Microsoft, Amazon, Google, Tesla, and 495 other companies. The beauty of this approach is that you don't have to pick winners and losers. You're essentially betting on the success of American business as a whole. If some companies in the index perform poorly, others will likely perform well, balancing out your returns. Index funds also have very low fees because there's no fund manager actively picking stocks. The fund simply mirrors whatever companies are in the index it tracks. This means more of your money stays invested and compounds over time, rather than being eaten up by management fees. ETF stands for Exchange Traded Fund. And for our purposes, you can think of ETFs and index funds as very similar. Both give you diversification, both have low fees, and both can track the same indexes. To buy these investments, you need to know their ticker symbols. Think of ticker symbols like airport codes, JFK for New York, LAX for Los Angeles. Every investment that trades on the stock market has its own unique symbol. For example, Apple's ticker symbol is AAPL, Microsoft is MSFT, and Tesla is TSLA. A popular ETF that tracks the S&P 500 is VO, offered by Vanguard. Another popular one is SPY. These both give you exposure to the same 500 companies, just packaged slightly differently. Here's why I prefer index funds and ETFs over individual stock picking, especially for beginners. Individual stocks can be incredibly volatile and unpredictable. For example, if you had bought Intel stock at its peak in 2000 for about $72 per share, you still wouldn't have made your money back today, more than 25 years later. Meanwhile, the S&P 500 has returned more than 4 times your investment over that same period. On the flip side, if you had picked Nvidia stock at the right time, you would have done incredibly well, far outperforming the overall market. But here's the problem. You don't know ahead of time which companies will be the next Nvidia and which will be the next Intel. By investing in the whole market through index funds, you capture the average return of all these companies, which historically has been quite good. Let me give you a powerful example of what consistent investing can do. If you invest $6,000 per year, which works out to $500 per month, into the S&P 500 for 35 years, assuming the historical average return continues, you would end up with well over $1 million. That's the power of starting early and being consistent. This brings us to one of the most important questions. When should you start investing? The answer is as soon as possible, and here's why. Many beginners think they should wait for the right time to invest, maybe when the market dips or when they have more money saved up. But research shows that the stock market reaches new all-time highs about 8.3% of all trading days. That's roughly 21 days per year when the market is at record levels. Here's the really important part. New all-time highs are usually followed by more all-time highs. If you're sitting on the sidelines waiting for the perfect moment, you're likely to miss out on significant gains. Studies have shown that missing just the 10 best days in the market over a 30-year period would reduce your total returns by 54%. Missing 20 of the best days costs you 73% of your gains, and missing 30 days results in 83% less money. Since you can't predict when these best days will happen, the safest strategy is to stay invested consistently. I know it feels psychologically difficult to buy when markets are at all-time highs. Nobody wants to feel like they're paying the highest price ever for something. But remember, paying today's prices to participate in tomorrow's growth is exactly how wealth is built over time. One of my favorite financial writers, Nick Maggiulli, wrote an excellent article called Just Keep Buying. His main point is simple. Rather than trying to time the market, just keep buying consistently, whether the market is high or low. He demonstrates this with data showing that yes, when you buy stocks at high prices, your short-term returns might be lower. But if you hold for longer periods, 20 to 30 years, these timing differences become much less important. Over any 20-year period, US stocks have never had negative real returns when including dividends. There's a perfect example of this from 2012. If you search online for stock market overvalued 2012, You'll find numerous articles from that time claiming the market was overpriced by 50%. The S&P 500 was trading around 1,400 back then. If you had believed those articles and stayed out of the market, you would have missed enormous gains. Today, the S&P 500 trades at levels nearly 4.5 times higher than those overvalued 2012 levels. The lesson is clear. Time in the market beats timing the market. When it comes to actually investing your money, you have two main approaches: lump sum investing or dollar cost averaging. Lump sum means investing all your available money at once. Dollar cost averaging means spreading your investments over time, investing a fixed amount at regular intervals. Both strategies can work, but I generally recommend dollar cost averaging for beginners because it's psychologically easier and helps you build good habits. Here's how dollar cost averaging works. Instead of investing $12,000 all at once, you might invest $1,000 every month for 12 months. When prices are high, your fixed amount buys fewer shares. When prices are low, the same amount buys more shares. Over time, you average out your purchase price and reduce the risk of investing everything at a market peak. More importantly, dollar cost averaging is easier to automate, which takes the emotion out of investing. You can set up automatic transfers from your bank account to your investment account, making investing as routine as paying your monthly bills. Now, let me address a common question. How much money should you be making before you start investing? Some people say you should invest whatever you have, but I think consistency is more important than the absolute amount. If you're a teenager or recent college graduate with only $100 to your name, it might be better to invest that money in developing your skills and increasing your earning potential first. However, if you have a steady income and can consistently set aside money for investing, then you should start as soon as possible. I personally started investing when I was making around $55,000 per year, putting away $100 to $200 per month, plus any bonuses or tax refunds. The key is finding an amount you can invest regularly without affecting your ability to pay your essential expenses. It's better to invest $50 per month consistently for years than to invest $500 once and then nothing for the next year. This brings us to understanding yourself as an investor. You need to be honest about your risk tolerance, your goals, and your time horizon. Are you someone who can handle seeing your account balance go down 20 or 30% during a market crash and still sleep well at night? Or does that level of volatility make you want to sell everything and hide your money under the mattress? Your age and when you'll need the money also matter enormously. If you're 25 years old and investing for retirement, you can afford to take more risk because you have decades to recover from any short-term losses. If you're 60 years old and planning to retire in 5 years, you probably want a more conservative approach because you don't have as much time to make up for losses. The general rule is that when you're younger, you can be more aggressive with your investments because you have time on your side. As you get older, you typically want to gradually shift toward more conservative investments to protect the wealth you've built. Remember, investing always carries some risk. The stock market doesn't go up in a straight line. There will be years when you lose money, years when returns are flat, and years when you make significant gains. The key is understanding that over long periods, the overall trend has been upward. If I was starting my investing journey today, in 2026, here's exactly what I would do. First, I would educate myself on why investing is important, which is what we've covered in this video. Understanding the why behind investing gives you the motivation to stick with it during tough times. Second, I would open either a retirement account or a regular brokerage account with a reputable, user-friendly company like Fidelity, Robinhood, or Charles Schwab. I'd avoid companies with complex interfaces or high fees. Third, I would invest primarily in broad market index funds or ETFs that track the S&P 500 or total stock market. This gives me instant diversification and historically solid returns without requiring me to pick individual stocks. Fourth, I would set up automatic recurring investments to dollar cost average into these funds over time. This removes the emotion and guesswork from investing and ensures I'm building wealth consistently. Finally, I would continue learning about investing and personal finance. The more you understand, the more confident and successful you'll become as an investor. The beauty of modern investing platforms is how simple and accessible they've made this process. What used to require calling a broker and paying significant commissions can now be done from your phone in minutes, often with no trading fees. Remember, investing is a marathon, not a sprint. Your goal isn't to get rich quickly or to perfectly time the market. Your goal is to consistently invest money you can afford to lose in the short term, allowing compound interest to work its magic over years and decades. Don't get discouraged if your account balance fluctuates in the early days, weeks, or months. This is completely normal and expected. Focus on the long-term trend and keep adding money regularly. Also, resist the temptation to constantly check your account balance or make frequent changes to your investments. The most successful investors are often the most boring ones. They pick good investments and stick with them through all market conditions. One final piece of advice: start today, even if it's with a small amount. The biggest mistake you can make is waiting for the perfect time to begin. There will always be uncertainty in the markets and reasons to delay, but time is your most valuable asset when it comes to investing. And every day you wait is a day of potential compound growth you're missing out. The difference between someone who starts investing at 25 versus 35 is enormous, even if they invest the exact same amount of money. That 10-year head start can literally mean hundreds of thousands of dollars more in retirement wealth. Whether you're 18 or 58, the best time to start investing was yesterday. The second best time is today. Take action on what you've learned, open that account, and make your first investment. Your future self will thank you for taking this crucial step toward financial freedom. Remember, you don't need to be perfect, and you don't need to have everything figured out. You just need to start. As you gain experience and confidence, you can always refine your strategy and potentially expand into other types of investments. The journey to building real wealth through stock market investing starts with a single step. Make that step today, and you'll be amazed at where you can end up in the years to come. Thanks for watching, and here's to your investing success. If this video helped you feel more confident about investing, do me a favor, hit that subscribe button and turn on notifications so you never miss a video. Every week, Billy is here breaking down money, investing, and personal finance in a way that actually makes sense. No fluff, no jargon, just real strategies you can act on. And if you want to keep learning right now, I've picked out another video just for you. It's playing at the end of this screen. Go watch it and keep building those money skills. Thanks, and see you soon.